Alright guys, welcome to my first video. This time I'm presenting you a freight company, Old Dominion Freightline. And here you can see one of their service centers. Here you can see some tractors. Here's the service center. All the trailers here lined up ready to be loaded. Here's a parking spot for their employees. And here you can see some more trailers. So this is a very interesting company. It's performed very well the last pretty much 15 years, being one of the best performing stocks in the stock market. So there must be something behind it. So for those of you who haven't researched the company at all, they have 22,900 employees, 260 service center. You can see they're spread across the whole United States, mainland United States. You could say 48 states. They don't have any service centers in Hawaii and Alaska. You can see they're very well spread out, so they have a very big, diverse network. We'll talk about that in a minute. They have 10,791 trucks and 46,414 trailers. You'll probably be wondering, they have so many more trailers than tractors, but you'll see in a minute why. They're the second largest, less than truckload freight carrier, the biggest one being FedEx, and other competitors being JB Hunt, Knight and Swift, CH Robinson Worldwide, and so on and so forth. There's a few more of those, but you can look that up yourself. As of December 31st, 2023, it had 45 billion market cap and $5.87 billion in revenue. But recently it took quite a big dip because the latest earnings call, the board had a very bad outlook for the economy. So the stock right now, the market cap is at 39 billion. So the most of the revenues come from four different sectors. So most of the revenues come from Old Dominion Domestic, which is just their LTL business, regional long haul LTL business. Then they have some revenues from OD Expedited. That means it's their time sensitive and appointment shipments pretty much they're express, so same day or second day, next day delivery. They have some other services, container drayage, so pretty much taking containers from some kind of ship terminal and bringing it somewhere. Truckload brokerage, so for example, giving jobs to independent drivers or to any other type of carriers, but that's a small part of the business, comprising only 2% of total revenue. And they also have some global parts of the business. So they do trucking in Canada, Mexico, Puerto Rico, and other locations. The revenue has grown steadily since 2000 with a 11.8% revenue CAGR. So even if you bought 2002 at quite a high valuation, if your companies grow with 11.8% CAGR over, what is it, 21 years, then it doesn't really matter because you would probably still have made money. You can see the company does lack during a recession. So 2009, the revenues, also the net income, the CL line went down. And when there's like not a big economic boom, the revenue kind of flatlines. And also right now it's starting to dip again because the economy took a bad turn since inflation and also kind of all these unsolved COVID problems are still here. But in general, you can see after every recession, the company has managed to come out stronger than before, and you'll see why. So they have, I call them the 7 pillars for their strategic foundation for success. We'll go into each one of them with the help of the annual report. But pretty much what they want to do, they want to focus on the growing market segments, deliver superior customer service, maintain pricing discipline, so offset cost inflation, right? Don't give too much inflation to the clients so they keep coming back to you. Maintain a strong financial position because, as I said, they're impacted by recessions. So it would be bad if you have to pay off a lot of debt during a recession when your cash flows go down. So they want to maintain a strong financial position. Strengthen the service center network. Of course, make your service center network bigger. Make more offerings to clients. Be able to deliver longer haul trucks and longer haul loads. Invest in equipment and IT and infrastructure. Also very important, keeping up with the time, investing in IT systems, making your delivery more efficient, giving the clients opportunity to track their delivery and see where their load is being transported to, how long it takes, so on and so forth. IT, they also call it systems that increase customer connection and yield. Of course, you get more money and you get more customer satisfaction if you can deliver on time and also more efficiently. But I'll talk about that later. And taking care of employees, which is very, very important. Because if you don't take care of them, especially in the trucking industry, which has an average turnover of 6 months for a driver, they will switch company and leave you. So you really got to pay them good wages and have good benefits, have good bonuses. That's also very important. We'll be looking at that because that's one of the main things in trucking. It's the truckers. Because if you don't have people driving your trucks, you're not making any money. All right, first of all, let's look what they say about the competition. So it's intensely competitive and highly fragmented. Why is that? Well, first of all, they're not only competing with other LTL and international or carriers or truckload carriers, they're also competing with air freight carriers and, of course, railroads. The thing with air freight is it's kind of limited because, first of all, you need to own a plane. The plane can only carry a limited amount of goods, let's say. Of course, a train and a truck also, but compared to the fuel cost, it's a lot higher. And railroads, they're way more efficient. Trains are the most efficient form of transport. They have the train tracks have the least amount of resistance, and also you can make trains very aerodynamic. The problem with trains is you can build the railroad everywhere. They're not very maneuverable. So trucks are still the most used form of transport for freight, for industrial freight of any kind of type. We also compete with and provide transportation services to third-party logistic providers that determine both the mode of transportation and the carrier. So what they're saying is they also compete with like some big kind of corporations like UPS, those DHLs, also some um, only like how do you call it, logistic service companies, which are also asset light. They also kind of compete with them. But Old Dominion has many competitive advantages that those other small truckers, railroads, air freight companies, logistic service companies, and so on don't have. Here's what the management has to say about it. We believe we're able to gain market share by providing high quality service at a fair price and intend to expand the capacity for our network to accommodate future growth, which they have done. We'll see later on. They continuously seek to improve customer service by maximizing on-time performance, so bringing their trucks on time, making the client happy, and minimizing cargo claims. So they also bring the transported goods in a very good shape and also very fast. They believe their transit times are faster and more reliable than their national competitors because of their more efficient service center network, their use of drivers and proprietary technology. So that means they have invested in IT, they have trained their drivers, paid them well, teach them how to unload the trucks, how to load the trucks. They don't need two or three people to load the trucks, they just need the driver. They have their IT systems, they have their service center workers, so that's how they're very effective and can bring trucks everywhere on time. All right, they also have value added services offerings. As I said, they offer their customers those IT systems which they can follow the delivery, and also they have those container data and so on. They have some different type of services which makes the customer happy. Of course, if you don't have need to have three different companies moving your load around, you just go to Old Dominion and they provide all different kind of services. It's way less of a hassle. They utilize flexible scheduling and train our employees to perform multiple tasks. As I said, for example, the truck driver can load, unload the truck, can maybe do a little bit of trailer. He can connect the trailer, whatever. Like they're just multi-talented in general. They don't have one specific task, so they try to train them very broadly. All right. So we believe our focus on employee communication, continued education, development, and motivation strengthens the relationship and trust among our employees. Yes, that's what I want to see in a trucking company, that they focus on the employee and like if a company in their yearly 10K, if they don't mention anything the first few pages about the employees, then I already know that long term, eventually, they might have some problems with employees, and I don't like that. I want the trucking companies to really focus on their employees and develop them and at least write some stuff what they're doing with them. Because if they can talk about margins and stuff all they want, but if the truckers are not happy, eventually those are not going to go along with it. Like the margins are not going to stay that high forever. And yes, of course, you have those 246 service center. Yes, you need a lot of capital to maintain them. Also, those over 10,000 trucks and the 40,000 something fleet of trailers. Yes, of course, high fixed costs, capital spending. Also, if you're growing your network, you need to invest a lot of money in those service centers. You need to build them. You need to order the trucks, so on and so forth. Costs a lot of money. The whole LTL industry had 43.8 thousand I'm sorry, $1 billion of revenue. And also they mentioned this again that it's highly competitive based on service and price. The largest 5 and 10 LTL motor carriers accounted for approximately 56% and the top 10 for 81% of domestic revenue. So I think this number is kind of misleading. Yes, it's true. 81% revenues come from the top 10 LTL motor carriers. But some of them, they also work with single like moms and pops shop style kind of truckers. So if I were to go to America, get a trucking license, buy a truck, buy a trailer, I can transport any kind of goods for any kind of company. I can work for Walmart and transport the goods around. But usually, I just have a company give me um, a task like, hey, you transport from this manufactured refrigerator to Walmart, and then they pay me to. I give them an invoice, they pay me, or they just tell me what the rate is. Usually, they give you a rate, you don't send an invoice. Usually, the truckers don't have that much pricing power to send the invoice themselves. It's not like consulting industry where people just send invoices to the company. You get told the rate, and you either take it or you go with another company, like CH Robinson and JB Hunt. Also, they don't only have their own drivers; they also hire other drivers to work for them. So don't think that the industry is consolidated and 81% make 10%, 10 biggest companies make 81% of their earnings. That's not entirely true. It's still very highly fragmented industry when it comes to the drivers. Here's actually a very important part. It's only four and a half sentences, but actually it includes a lot of knowledge you can learn from this. We utilize scheduled routes and additional line haul dispatches as necessary to meet our published transit times. In addition, we gain efficiency through the use of twin 28-foot trailers in our line haul operation. The use of twin 28-foot trailers permits us to transport freight directly from its point of origin to destination with minimal unloading and reloading. And in some states, they even use 48-foot and 28-foot trailers. Yeah, this makes sense because look, if you have two trailers and you can, how do you say it? So you have two trailers, right? Like this. This is trailer number one, this is trailer number two, and here's your truck driving everything. Okay, this is your pretty truck, and here you have some tires, and here you have, I don't know, some kind of here's a refrigerator, right? Well, if your IT systems are according to nowadays standards, you can input the client, the different loads you have in the trailer. You can input your client, you can input the service center where you have to go, and the program will just tell the trucker, hey, you have this much time until you have to arrive there. You only have to unload this from, let's say, the first trailer, this from the second trailer, or maybe sometimes they'll even undock both trailers, bring a new trailer, or just remove the second trailer, put a new one in, and then he can keep going. So it's very efficient. It's not like if you're a lone trucker and you have to plan, oh, I have a refrigerator, I have some tires, oh, where do I put them in? Do I put them at the back of the trailer, at the front, at the middle? And then like you forgot where they were, then you kind of, I don't know, had a bad day and loaded everything up wrong. Then when you arrive at the customer, you gotta unload some stuff from other people, and then you can reach the customer's load. So this wastes a lot of time if you have to rearrange your trailer every time. But you have really good software and also experienced drivers, which are good at arranging the trailers, and also service center workers, which prepare the trailers for the incoming truck, and the truck just has to attach the trailer and can keep moving to a different service center that's very efficient. And you can also, I'll show you in future graphs and further graphs that their claim ratio and also their arrival time is very, very good. Service center operation. So 257 centers, as I said in the beginning. Most of them owned. This is pretty much what the most important thing of this paragraph is. They own most of them. They only lease 24. So that means they're pretty much immune to any kind of inflation, or if they have to rearrange a lease, there's no some landlord that all of a sudden wants 10%, 20% rent increase. No, they own most of them. So even there's a recession, they don't have to renegotiate that many leases. So they'll be fine. They'll still have, of course, some sustaining capex, but most of it is almost fixed. So here you can kind of see those pillars again. We talked about that they're efficient. So you can see 70% of shipments are next or second day. Unique network allows for growth. Yes, of course, big network. On-time service has improved. So they have improved on-time service from 94% to 99%. 99% of their shipments arrive on time. Imagine if 99% of your trains arrived on time, how happy you would be, or if your Amazon package arrived 99% on time, then you would probably won't be so angry. Cargo claims ratio has declined from 1.5% to 0.1%. So only 99.9% of cargo arrives in a fine condition. No, there will, like, the client is 99.9% of the times is happy, it arrives on time, and it's not damaged. Long-term approach to pricing that is focused on offsetting cost inflation. As I said, they don't pass on the costs because their costs are limited because everything is owned. They treat the drivers well, and everything arrives on time, so it's fine. We'll look at the depth later. And also, as I said, they have a lot of service center. They've been growing them since 2014. I have some good graphs for that later. The IT system, and also, as I said, they take good care of their employees. Here you can see in the graph what was there before. From 2002, from 1.6 cargo claims as percent of revenue to 0.1%. So their efficiency through good driver training, through good service center worker training, through the IT systems, they have managed to make their cargo claims almost non-existent. Here you can kind of also see the pricing power they have. It's a four-way graph representing the economy offering, the inferior offering, premium offering, superior offering. On the X scale, you have the higher and lower performance, and the Y scale, you'll have the lower and higher price. Old Dominion is priced above average, but they're still within, at least that's what they say, within the fair value line. And also they're into the premium offering, let's say, quarter. So they're kind of the only one having those premium offerings, those separate services that they talked about in the beginning. And all the public competitors, many of them, they're either just like good but way too expensive, or they're bad and then cheap. But of course, if you have the choice, you would go with something that is, let's say, a little bit above average, but they're super good and everything is fine. It's very high quality, because if you pay cheap, you usually pay twice. All right. Here, the revenue per shipment. Yes, of course, with increased efficiency, the revenue per shipment also increases, also goes up, because they have to pay less costs for any kind of damages if the shipment doesn't arrive on time or if there's any loss claim. Their capital expenditures. So, as I said, they've been increasing the amount of service centers, investing 2.1 billion to expand their network. Capital expenditures typically between 10 to 15% of total revenue. Tractor and trailer purchases were reduced, yes, because they anticipated lower shipment levels. So they can, there was COVID, so They reduced the amount of spending, especially in the tractors. The real estate, they kept it up. They kept investing in the real estate. They kept building new service centers, right? And that's what I like about this company. No matter what happens in the economy, they'll keep investing. While others have to penny pinch, have to save, have to put money on the side. They won't be penny pinching. They'll keep investing. And when the economy gets good again, they'll come out pretty much guns blazing. They will be making more money than you, and they will have taken market share from you and taking your customers away. Here you can see the balance sheet. So pretty much what I was talking about, they have a very good balance sheet. They have negative debt, so minus 200 million net debt. So if there's a recession, if there anything goes bad, if their net income goes down, they don't have to pay off any debt. They own their centers. They have no lease, barely any leases. So even if there's a recession, which they can do nothing about, they'll be fine. Here you can see the number of tractors and the trailers again, and also the number of pickup and delivery trailers. So less than truckload pretty much works this way. You have, as it says in the name, less than truckload. So your trailer is not full with merchandise. So how it works is, let's take the refrigerator example again. You send a small van or some smaller truck to the manufacturer, pick up the refrigerator, bring it to the service center, load it up in the trailer, and then that's where it goes into the line haul trailers. From the PD trailers, it goes to the line haul trailers. Line haul trailer gets attached to the tractor, then it goes on its way. And that's also the number you can see, because most trucks run with two trailers. So it's almost double the amount of trailers, the amount of trucks. So it's 31,000. You have 10K extra because you also have some laying around being ready for any kind of delivery you're not expecting. And also, as I said, sometimes they also do just trailer switches instead of unloading them completely. And here comes a bigger number to those 46,000, the P&D trailers. So the smaller trailers you need to just pick up the smaller merchandise, bring them to the service center. Also very important here, average age. When you look at this type of company which has a lot of assets, first of all, you look at what type of assets it has, right? So in this case, it's real estate, land, and tractors. You think about, where does most of the capex go? As we've seen, they invest in either new service centers, but the sustaining capex for the service center is not that high. What is sustaining capex for the tractors is higher because they have to maintain them, and also it's not, of course, growth capex buying new trucks, but you also have to replace the old ones. So that's also kind of a sustaining capex, not really a growth capex if you want to keep the same amount of tractors. So you got to look at their age, because if, for example, the average age is 20 years, then all of a sudden you haven't looked into it, and then there's a AK or something coming out, and then, oh, my company has to suddenly spend 1 billion during a recession when their income is only 500 million on buying 5,000 new tractors because I didn't look at the average age, but their age is very good, 4.5 years. Also interesting, you want to see how they maintain them. So they have a 90-day maintenance policy. So every 90 days they look at the truck. That's also very good because those trucks drive a lot of miles. So you need to keep them in order, check the brakes, check the tires, check the hydraulics. And they do that in their 46 maintenance centers. So they also have their own maintenance centers, which is actually also a very big play. And also, if you're interested, here is the capital expenditures for the tractors and trailers. So you can also calculate that off the net income and see how much is left over. And then you can also kind of guess how much is sustaining, how much is growth capex if you look into those numbers exactly. But I'm not here to do that. All right. Service center capacity. Here you can see yellow, the freight carrier which went bankrupt. They went bankrupt because they did a big acquisition. They couldn't integrate that into their business. This also happens often. Businesses buy other businesses and they can't really integrate them into their daily business because of, for example, bad management or different culture. Especially in the trucking industry, culture is very important. Many truckers don't support certain type of political themes, political movements. I don't really want to get into those, but truckers in America, especially, they're usually very conservative. And if you buy a certain type of company, especially if it's a smaller company, you try to integrate it, and the culture doesn't fit, you don't have really good management, then it will fail. And that's what happened with Yellow. And then came also bad times when their net income went down. They took a lot of debt to buy that company, and that's how they went bankrupt. And also their workers unionized because they didn't have enough money to pay their workers well, so they unionized, and then they pretty much drained every cent that was left in the company, and they went bankrupt. Who profited from this? Seiya Inc. and also Old Dominion, because then the market is the same, but the competitors is one less. So, and they were quite a big competitor. They're one of the biggest. So you can see their number of service centers went down, yes, because they had to sell them. They had to get rid of them to get lower capex. FedEx Freight increased their service centers. XPO ArcBest decreased them. T-Force decreased them. Seiya Inc. increased them. I also own shares in that. And Old Dominion also increased them since 2012. And what can we see? Oh, the amount of service center correlates with the amount of shipments. So if you have more service center, you get to make more shipments and also get more revenue. Seiya increased their service centers, 21% revenue increase. Old Dominion increased their service center, 75% revenue increase. FedEx increased their service center, 32% revenue increase. Also, ArcBest decreased their service center, but they increased their revenue. That might also be due to Yellow bankruptcy and some kind of different strategy they had, but I haven't looked that deep into ArcBest to make any kind of informed decision or to give any informed information, let's just say. But in general, you can see less service centers, less shipments made. You can have those nice long haul lines, which you need to make fast shipment and efficient shipment. So you need to increase your number of service centers, and also you have to make them in strategic locations. You can't just build them out like crazy. But that's what the management has done since 2002. So they'll probably keep doing that forever. All right. Capital allocation. So as I said, they spend a lot of money on capex, which is good because it's sustaining and also growth capex. And everything that is left over is returned to us shareholders in form of either share repurchases and dividends. And in 2022, they did a lot of share repurchases. When I see stuff like this, I look into it. I look into the stock price. And if you look into the stock price, you will see that in 2022, the share price was depressed. And that's a sign for a very smart management. That means that they buy the stock when it's cheap, which you should also, in general, don't buy a stock when it's expensive. But expensive is always relative. It's hard to define expensive or cheap in stocks. But in the aftermath, it has shown that the stock at that point was expensive, and these kind of share repurchases create a lot of long-term value for shareholders. And when the stock is expensive, they don't buy that much of it back. So they have their capital allocation is very good. Capex, growth capex, and the rest given to us. And also, you have a little buffer for bad times. That's perfect capital allocation. Top 25 LTL carriers in 2002, 45% of them were unionized, 52% were non-union. And Old Dominion Freightline made 2.9% of the market. The market has grown at a CAGR of 5.1%. Now it's 52.5 billion, and Old Dominion makes up 11% of the market. So within 20 years, they have gained around 7 to 8% market share, right? And the amount of unionized LTL carriers have decreased because when you have unionized employees, you have a big disadvantage because usually they get a yearly raise, which maybe you don't necessarily agree with. They also get certain benefits, certain vacation benefits, certain holiday benefits, and when you have your single employees, let's say you can kind of gaslight them more and give them benefits, give them good wages, and the ones who are not that educated, who are not that long in the industry, you can gaslight them maybe a little bit more. Still treat them well, it's important, but you do have some leverage with more employees, let's say. Here you can see the different market shares in the regions of the US. They have been increasing steadily, no matter where, gone up, and pretty much every region, it's around like 12 to 15% market share. Revenue per service center. as you can see, the revenue per service center has been increasing steadily. Per service center, that means their efficiency has gone up. And this correlates exactly to the operating ratio. The operating ratio is the amount of revenue that goes to the cost of running the company. So to the fuel, to the paying the employee wages, to paying the benefits, and so on and so forth. Not the growth capex. Operating ratio is 72.5%. For example, train companies, they have operating ratios of around 59 to 65%. That would be your Union Pacific, your Canadian National Railway, your Canadian Pacific, Kansas City Southern, because train are way more efficient. As I said, you can have a lot of wagons. You only have one person driving the train, and the general rails have way less resistance than a road, than tires driving over a road, right, a highway. But in general, 72.5% operating ratio for a trucking company is really, really good. You can look into the operating ratios for other companies, and also I like when it correlates to the revenue per service center. The lower they spend, the more revenue they make per service center, per truck, per whatever. Here you can see also the stock price the last 5 years. It's only known one way, and that is up. Expect until recently the stock has quite crashed. That doesn't happen very often, especially by this much in such a short time frame. In 2022, you can see here the stock price was quite depressed. It went down from a high back then, and the company decided to buy back a lot of stock. So that was smart, because that proved to be a good decision. Here's the statement for the cash flow. You can see they have 1.57 billion, 1.6 billion around of operating cash flow, and after those investing and financing activities, they have around 800 million of free cash flow left over. So a lot of growth, a lot of like dividends, share buybacks, and so forth. If you run a quick DCF, here I run only normalized, so operating cash flow. I was too lazy to change this. So 5-year average revenue growth 7.4%, 5-year average operating cash flow growth 17.2%. Return on invested capital, you always want to see that being high, but that can also be kind of tricky, because if you look at cyclical industries like the trucking, sometimes it's very high when the times are good, but it's also very bad when the times are not good. So you also have to account for that, like your average ROIC. That's why 5-year average is quite good if there hasn't been a very long recession. So 26.7% for that. And if you assume that your multiple, your price to operating cash flow stays the same at 25.4, 10% discount rate, first 5 years, your company grows 17% operating cash flow per year. In the next 4 years, so till 2034, 15%. Then you'd get a 5.5% per year average return. So it's not that high, 5.5% per year, but this company can hold some surprises, and also if the share price goes down, it might also even have more return. Also, the multiple can also go up, but also can go down. Never know what happens. Interesting to know, Old Dominion used to be a family company, so Condon family owns about 12% of the outstanding stock. Can be a risk because they have a significant impact on the outcome of any kind of shareholder vote. But in general, when a company is family owned, they usually pursue longer value creating decisions. So they're usually not that asset light. They follow some long-term plan, because the family, what do they want to do? They want to preserve the capital, just like me, and in the future also increase it, just like me. So it's good if the family thinks the same as you. It's the same kind of for Corpart and other different companies like Pernod Ricard, MS, and so on and so forth. Here I want to show you what the operating ratio is comprised of. So as I said before, 44.8% of revenues goes directly to paying off the truckers, their wages, their benefits. It's important. And yeah, it comprises a high part of it. Imagine if trucks could drive themselves, then their operating ratios will be better than trains. That would be crazy. That's, yeah. But we don't have those yet. Here I'm talking again about like the acquisitions, integrated acquisitions. The same as explained with Yellow, like the failed integration. That's kind of what led them to bankruptcy. So acquisitions, kind of a make and break situation. And their strategy is Old Dominion strategy. They want to make acquisitions. They have made acquisitions, but they say like, hey, we may not be able to make good acquisitions, but I believe in the management. I believe in the culture of the company that they can integrate small truckers, small companies very well. And in case of a recession, they don't have any debt. They own their senders. They own their tractors, their trailers. They have the cash. Even if the cash flows will be reduced, they can make those acquisitions. They can hire those truckers, which all of a sudden, the Walmarts and the Pepsis and the UPSs, they don't wanna, they don't need those mom and pops drivers. They need some serious service, some added-on service, some competitive pricing. Then those truckers will give up, come to Old Dominion. As I said, management stays competent and integrates their culture um, very well, then the acquisitions will, in the future, once good times come, result probably in increasing cash flows. And the cash flows are always fundamental. That's what matters the most. If the cash flows in the future don't increase, then the share price will also not increase, and you will not be rewarded as a shareholder. Here I show this again how Old Dominion tries to outline the importance of shareholders. They really rely on them. Here they have foster a culture of safety and performance excellence. So they try to motivate them. Also providing industry competitive compensation, robust benefits package, and career advancement opportunities. So even if you're the trucking industry, they still provide you with different types of training, management training. Maybe you can learn how to drive a forklift. Maybe if you're really good at organization, you can make some management training, become a manager, become a service center manager, a trucker manager, so a maintenance center manager. Who knows? And also, what I really like about Old Dominion, they pay their truckers safety bonuses. So you don't want your truck to crash because then there will be a big cargo claim and the customer won't be happy. And maybe they'll search for someone else if there was a really dumb crash. So of course, the truckers will drive more carefully if they don't crash and they get a $5,000 bonus per year just for driving safe. Of course, they'll be driving safe. That's a good incentive for the drivers to drive safe. Um, some risk. Yes, as I said, I don't see any operating risks with the company. I think the management is really good. I think the employees are doing a really great job. You can see the loads. They also always arrive on time pretty much. They have low claims, but there's always the recession risk because this company cannot control the economy and most of the freight in America is moved by trucks. So when there's an economic downturn and people are buying less stuff is being transported around and they will be hit. You can already see in 2022, the revenues were 6.2 billion. They have now decreased to 5.8 billion. The operating ratio went up. That means their costs have went up, also due to inflation and probably due to pricing. So that means there's not as many shipments as before. So to compete, they have to lower their pricing. That's why the revenues go down and the operating ratio goes up. Also, next thing, net income went down. That further strengthens my thesis. Um, the LTL tons, less than truckload tons, they have decreased. So that means there's less merchandise moving around. The economy is slowing down. LTL tonnage per day also went down 9%. Right? This is really not looking good. It looks like the economy is either slowing down or even heading into a recession. You can't predict that, but the numbers they hit those trucks first because that's the backbone of the especially American economy. Here you can also see the salaries, wages, and benefits decreased 87.2 million or 3.2%. Um, you want to first see like, oh, they decreased their wages, what? But if you read further, you see it's primarily due to the decrease in the average number of active full-time employees. That means they just let some employees go. They either fired them or they let them go into retirement and don't replace any of them. And that is to align with our customer shipping trend. So there, that means Old Dominion is already preparing for a downturn in the economy, so they don't have that high of wages and they don't have some truckers just waiting around being paid but not actually moving any merchandise in case there comes a big recession or a big economic crash. Um, increase the separate. See here, productive labor costs and wages for drivers have increased. So that means in general, per driver, they pay more, their wages have increased, have gone up, but the number of drivers have gone down. So nothing to worry here. It's actually quite a smart move that they're bracing for, let's say, economic impact. Now, some general information that I think gives a lot of backwind to the industry. So trucks move roughly 72.6% of the nation's freight. So those 18, what is it, 20 something percent, the rest, yes, that's being moved by trains and by planes, by also by boats. So those 27.4%, yeah, you think like, oh yeah, train transport, all this stuff around, blah blah, but no, it's actually the trucks moving the nation's freight. And we were thinking, yeah, but train is way more efficient, or maybe there'll be some drones moving my stuff around, and like why wouldn't the why wouldn't the companies do something else? Well, the thing is, the auto industry and also probably also the trucking industry, that's a lot of jobs, and they have a very very big political influence in America, and also a lot of lobbying, and you can see that by kind of the government spending. This is the bill project, which is I think it's a part of the Inflation Reduction Act, and the most money the government is spending for infrastructure is going to either internet, or almost half of it, it's going to roads, bridges, and major projects. So even in the future, the government still sees potential. At least I don't know if they see potential, but that's what they want to spend the money on roads, bridges, and major projects. So there will still be highways, there will be new bridges, there will be new roads, which will the trucks will be driving around and bringing your chips, your lace, your refrigerator, and so on and so forth to Walmart. And Old Dominion and different LTL carriers will profit from that. So that means the market will not get smaller, especially with incoming manufacturing capacity to America. China, like, is not so in right now for many companies. They're still trying to make a lot of money in China, but at the same time, they're trying to not invest as much in China. So they're bringing their manufacturing to Mexico, to America, to the States in general. So those trucking companies will also profit from them moving their machinery, their the employees' foods, the different machines you need for running the economy. They'll profit from this, and also you can see this in the public spending. So I thank you for listening. Old Dominion will keep on helping the world's promises, as they say in their near their logo. And I hope you could get some value from this one. Thank you for watching, and see you next time.